Hi, everyone. We have all heard about Bitcoin, which started as an antidote to the top heavy financial system and later as a movement to syndicate a distributed, decentralized parallel currency into the fundamental model of the market. 2017 saw a huge rise, and everybody was talking about Bitcoin and blockchain technology. But after the market simmered, there are a handful of people left who are continuing their fight to bring movement. Today, we are going to talk to a woman fund manager with a team of serial investors in the blockchain space. She grew up in a volatile economy that could wipe out fortunes from day one to the next. Previously, she worked as an investment director at Gartner and worked alongside with some of the top investors in Silicon Valley and outside. Welcome to She VC. I'm your founder and host, Gayatri Sarkar. So today is that special day. We have Kate Mitselmakher with us. She's the founder of Bloccelerate VC Fund. Super excited to welcome you, Kate.
For having me. Yeah, it's a pleasure to be here, and I'm looking forward to a great conversation.
Absolutely. And I want to give a shout out to Anand, who made this introduction happen. He's an amazing when it comes to supporting women and women fund managers. So I want to first confess you are the first blockchain fund manager on SheVC, and I think I have not done enough of a great job in highlighting more women fund manager when it comes to amazing technology like blockchain. So I'm super excited to have you.
No pressure, huh?
First, I would love to talk about starting with, US 2008 recession, the financial and social crisis in Zimbabwe, Venezuela have been a big nudge for people like Hal Finney, Satoshi to start this digital currency revolution. Blockchain technology existed long before Bitcoin. But because of Bitcoin's huge price surge, we saw so much of movement and discussion from every conference to even White House press briefings. So now as the market simmered and the conversation is happening more at the enterprise level than at consumer level, I would love to know your take, like what is driving the value creation in the blockchain space today, and how will value creation be different in the next 10 years compared to the last 10 years?
Yeah, absolutely. So my background before coming to the United States and being fortunate to spend 10 years with a great organization called Gartner was upbringing in a very volatile economy. So the 2000 recession was not the first recession I've personally lived through. I was born in the Soviet Union in the household of aerospace engineers. Both my mother and father were laid off in 1991 when the Soviet Union collapsed, and both decided to start their own business. In 1991, we experienced 3,000+% inflation. So it was a very difficult time to go and raise capital. My mom went to a bank, which was the only bank in my hometown of 70,000 people, to get a loan out, and the interest rate that she was able to secure the loan was 100%. So not only did she have to return 100% over what she borrowed, but also adjusted to 3,000% inflation the following year.
Oh my God.
Not surprisingly, she went bankrupt. She tried again, went bankrupt again, a few times, failed, and then finally she started seeing some success and prosperity, and that was 1998. And if you remember what happened in 1998 in Russia, that was the year of the collapse of the Russian ruble. Central bank had defaulted on its payments. I still remember up until this day going to a kiosk to exchange Russian rubles for US dollars. And it went from 1 to 5 one day, 1 to 10 the following day, 1 to 20, 1 to 30, and now we're close to 1 to 75. And then at one point they had to remove 3 zeros from our currencies. So long story short, when I first heard about Bitcoin, that was probably in 2012, 2013. And to me, it was a natural hedge against local currencies that are volatile compared to even US dollar. So I personally started investing right around that time, maybe a year or two later. And I was fortunate to be in the right place in the right time, surrounded by a lot of smart people working for Gartner. So not only did I see Bitcoin as a potential investment, but I started seeing interest from large enterprises and large governments around the world to explore use cases where blockchain is more than just money as a service use case, but consensus over the wire on a set of different use cases where there's a multiplicity of stakeholders who are trying to get a hold of a single version of truth, be that land titles, as in the case of Honduras, or medical records, as in the case of healthcare institutions. So I started personally researching the space. I started playing with mining. I built a small mining farm myself. It was at the time I was moving to Seattle as well, so the electricity prices were much better. And in 2018, I thought it was the right time to pursue this strategy as an investment fund.
Wow.
So your question about value creation, which is the one that I think about the most, I think an interesting parallel would be to draw with what happened with the internet. When the internet was launched, it was primarily driven by enterprises. The largest of them all is the government, right? And large research institutions. In the case of blockchain, the adoption was being driven not by the government, but the people, and the retail adoption, as I call it, retail adoption of crypto. And that was the wave of adoption that we've seen over the last 10 years. I call it retail adoption of crypto, that is still accelerating today and will be taking place going forward for many, many years to come. But in parallel to that retail adoption wave, we're seeing two other waves. One of which is institutional adoption of crypto as an asset class that institutions are now offering to their clients. That started around 2014, 2015. And then enterprise adoption of blockchain, which started right around 15, 16 as well. So if I were to look out into the next 10 years compared to the last 10 years, I would say we're going to see a lot more value creation happen on those other two areas, such as institutional adoption of crypto and enterprise adoption of blockchain, which dictate what kind of companies we're investing with today. So I can go more into each one if you want me to, but I thought this would be a good place to pause.
Yeah, absolutely. I think when we first spoke, what resonated with me is your investment theses, like what kind of areas that you want to invest, because there are so many funds that are out there that they focused on a different kind of investment thesis. And your focus is definitely on the enterprise side. I would love to know how these enterprise platforms, they can monetize this technology.
Sure. So maybe I'll answer the first part first, which is how do you define what is a good use case? And that's something I alluded to earlier. There's two primary drivers because you can look at 100 or at this point probably 1,000 different proof of concepts within an enterprise and see which ones of them succeeded and which ones of them failed. The ones that have succeeded met the following two criteria. Number one is there's a multiplicity of stakeholders who don't necessarily know or trust each other and who are trying to get a hold of a single version of truth on a common denominator. And that common denominator could be anything. It could be a product traveling through supply chain. It could be digital asset traveling through the value chain in the capital markets. It could be healthcare record that is going through multiple healthcare constituencies. So it doesn't matter what that product is, but if you have that multiplicity of stakeholders, blockchain makes a lot of sense. The second criteria is standardization, the level of standardization. Because if the challenge with healthcare has been, and the lack of adoption, not just with blockchain, but with the rest of the technology, it's extremely non-standardized industry. Data is sitting in silos. People aren't, or systems are not communicating with each other. There's not enough standards that talk to each other. So the level of standardization is very important for blockchain to be a feasible solution at this time. So that's just the first part. In terms of monetization, there's three primary ways that companies are monetizing today. The first one is one that most are probably familiar with from 2017 ICO craziness, and that was raising money through token sales. They actually booked this as revenue. So that was one way that companies have monetized. And that proved to be not sustainable for most tokens, with a few exceptions. The second way is crypto infrastructure companies like Coinbase, for example. They're monetizing based on transaction fees. So if you purchase Bitcoin, they charge you a percentage of the fee, but it's free to access the platform. You can download Coinbase and you can use it. Well, you only pay if you transact, if you trade. The third way, and probably the closest to us as a fund, the types of companies we're investing in, is a more traditional enterprise SaaS recurring licensing model that enterprises are most familiar with. And those are not different from any traditional SaaS company that you probably are aware of. And the reason that we're doing this is because of our focus in the enterprise, and because enterprises are not comfortable with tokens yet, this is the easiest path to getting adoption. And maybe in the future, once we get more maturity with enterprises, we'll convert into more interesting monetization models with tokens and transaction fees and other models.
Wow, I love that answer. And considering what we're going through with COVID-19 as a venture capitalist, what do you think that how it impacted blockchain adoption? And also would love to know some of the trends, deal flow, and valuations during COVID-19.
Yeah, so we've seen in the short term, everything was very correlated. If you look at 2020 March of this year, the Dixie Gold Index, along with the Gold Index, along with the Zoom stock, all plunged or coming back up, including Bitcoin as well. But probably a couple months after, we started seeing the winners and the losers emerge. And we have seen Bitcoin, crypto, and blockchain emerge as a winner, along with the rest of the technology space as an outcome. And not saying that we're through COVID, we're still going through it, and we still have probably years to go, but early signs are showing that blockchain will become a critical part of the infrastructure of the new digital era.
Yeah, I totally agree with you.
Yep. So there are two ways to look at it, on the crypto side and then on the blockchain side. So on the crypto side, there's two trends that we can pick up. One is on the stablecoin rise. The stablecoins have exploded over the last 6 months, but specifically a year. It's actually been 10x volume. And stablecoins in circulations went up from 2.9 billion in 2019 to 20 billion in 2020, which is huge growth. Just to put things in perspective, PayPal, that's been in business for 22 years, is doing 2.5 billion of transaction volume per day. Stablecoins are doing twice that, 5 billion.
Wow.
Per day. And stablecoins have only been around for the last 5 years. We have full disclosure in investment in this space called MakerDAO. That's actually one of the best performing investments in there so far. The second piece is Bitcoin. Unlike what everybody thinks, Bitcoin has been one of the best performing asset classes of 2020. And I think there's a lot of macroeconomic factors that are establishing Bitcoin as the new store of value, especially in the fiscal conditions and policies that we're going through, where more and more institutions are looking for higher yield, risk-adjusted returns, and they're seeing Bitcoin as this safe haven or alternative asset that's not correlated with the rest of the market, and that gives them that upside. So that's on the crypto side. On the blockchain side, the use cases that we have seen come up or surface above others is a variety of tracking use cases, specifically in the context of supply chains. Supply chains have always been a mess, but now everybody can see through, because COVID has exposed the gaps in supply chains. So just to give you one anecdote, one of the companies we're actually in the stages of investing with right now secured a 7-digit contract with Islamic Development Bank in the last 2 to 3 months, because they were provisioning $2.5 billion worth of PPE equipment to 25 countries in the Middle East and Africa. And they want to make sure that the traceability of funds and traceability of that equipment is very transparent to them. When you're about to spend $2.5 billion on something, you would pay a little bit of money to ensure that it gets there.
Yeah.
And it's scratching the surface, right, of everything else that's happening. That's one. Number two is financial services and capital markets. Similar pattern of multiplicity of stakeholders and a common denominator, except for it's not a physical product that's traveling through the supply chain. It's a digital asset or piece of data that's traveling through multiple stakeholders. So an example would be Invesco had to repay their shareholders $105 million in March of this year because they failed to rebalance their portfolio in time. Everybody's working home, right? Everybody's trying to get on the same page on the single version of truth on the records, and mistakes happen, and then it's costing a company $105 million. So we have invested in another company called Symbiont that's addressing this issue for a number of companies. There's one last one, and that's CBDCs, central bank digital currencies, because cash is going away as we know it. Governments don't like it, people don't like it, businesses don't like it. The digital payments and central bank backed digital payments, digital currencies are coming up on the radar as well.
Wow, love that. Now, coming back to the fund management discussion. So, there are a lot of audiences who are actually on GVC. We have audiences which are LPs, diverse LPs, and obviously fund managers. And I always ask this question. Now, since you're investing in blockchain, I'm highly eager to learn that how have institutional LPs reacted to the exposure of this asset class, specifically after 2018, and what strategies do you propose to them?
Sure. So going back to what I was saying, that over the past 30 years, there has been a general trend towards the search for a higher yield, risk-adjusted return. To marry that with the fact that a 30-year US bond has peaked in 1981 in terms of its interest rate, which was 15%, and it's 1.4% today. 10-year US bond went from 6% to 6 basis points, while the expected returns of those large institutions has been flat. We have seen higher allocation towards alternative assets and private asset class, which Bitcoin, crypto, blockchain as an asset class would fall into. So to give you another example, pension funds allocation to alternatives was 7% in the early 90s. Now it's 30%. For endowments, it was 6%. Now it's 56%. But even with that influx of capital, venture capital only went from 1 billion of AUM in 1976 to 500 billion today. So 500 billion is just a drop in the bucket compared to the rest of the asset class. Even the private equity asset class is $4 trillion. So in the search for this higher yield, risk-adjusted return, venture capital, private equity, and alternative assets are naturally merging to the top. So now you might be asking, okay, so why would they be looking at the blockchain space and specifically venture capital within the blockchain space? Well, if you've noticed what happened over the last 5 years, we've lived through the hype and we're now at the bottom, at the rock bottom of the hype cycle, if you will. The rock bottom of the hype cycle is when you want to be investing in companies. That means that we have achieved that risk-adjusted timing versus investing in the top. And on top of that, it's almost akin to investing in the internet back in the 90s, where internet was just getting started and you have 20, 30 years of growth, phenomenal growth ahead of you. So it would be foolish of institutions not to be looking at this asset class. And the reason ventures is a good strategy is because of the asymmetric information. It's a classic asymmetric information type of investment where you can gain higher returns if you are getting exposure to the right companies that are fundamentally creating value by disrupting status quo or enabling large industries like financial services. And simply, you cannot get access to these deals if you're investing in the public market.
Yeah, totally agree with you. Now, coming back to what we were talking about, attracting LPs, and it is always difficult for an emerging fund manager to attract LPs. And obviously, we are talking about how institutional LPs can participate in these particular asset classes. But I would love to know your experience, especially because we have seen it is more difficult for women fund managers to attract LPs. And what kind of impediments are you facing as a woman fund manager raising a fund like this, especially when Bitcoin is not shooting to a moon and many consider this is not a rising asset class? Would love to know your take on that.
Right. So first and foremost, I would disagree with the statement that it's not a rising asset class, because Bitcoin, in fact, has been one of the best performing asset classes of 2020. But if you look over the past 10 years, a CAGR, compounded annual growth on Bitcoin, was over 200%. That's probably 10x what Amazon did over the last 20 years. So the fact that it's a rising asset class is important to establish. In terms of the objections, we have classical objections of what emerging fund managers would experience, regardless whether they invest in blockchain or artificial intelligence, right? That you have lack of track record in the institutional space, that you don't have the deal flow that you would if you had run 5 funds before. All the classical, emerging fund managers. But I would actually say that the fact that we're specializing in a very sophisticated area, which is blockchain, and then within blockchain, we're looking at a very complicated space, which is enterprise adoption of blockchain. It's actually differentiating or setting us apart from a lot of non-specialized, non-thematic funds out there, where if you want to get exposure to the enterprise blockchain space, that aren't a lot of fund managers that are specifically going after this space and that have the experience that we have in understanding enterprise space really well. So as you know, I spent 10 years at Gartner. I worked with hundreds of CIOs of Fortune 500 companies. I worked with enterprise software companies that are public now, weren't public before. And it's just not something that every fund manager has in this space.
Wow, I love that. And I think what you're targeting over here, specifically to the institutional LPs, to look beyond. Bitcoin and blockchain was such a clickbait space, and everybody was talking about, okay, we are all anticipating Bitcoin is going to hit like $1 million or $10 million. There's so much of speculation it's going at that time in the industry, but right now things have simmered, and this is much of a rising asset class, and this is much for mature players to play in this space. Now, coming back to the cyclicality, of the market, which we talked before. So venture capital is also one asset class, which is also cyclical. And, the boom bust cycle and the appetite for high risk, but it also has a lockup period for limited partners, as long as 15 to 20 years, unlike hedge funds. Now, I would love to know your take, because liquidity has always been an issue for LPs for a long period of time, in a time like this, when COVID-19 is hitting us. How do you approach liquidity position to your incoming LPs, or to your current LPs, when you are dealing with an asset class which is easily tradable?
Right. Well, I would say that we were fortunate to work with LPs that have a very smart, diversified strategy where they're investing in a variety of different asset classes and they're not exposing themselves to liquid strategies beyond what they can afford. But within the illiquid strategies, if you're not investing in a venture fund, or if you're not locking up capital directly with companies, there isn't really a way for you to get exposure to those early stage growth opportunities. We're not at a point with blockchain where we have hundreds of publicly traded blockchain companies out there. We're about to have one this year, which is Coinbase, fingers crossed, and then maybe one more next year, which would be Ripple. As the space matures, sure, you're going to have a variety of different exposure strategies from private to public, but at the moment, you almost have to give up that liquidity in favor of the growth. With that said, if we are going to eat our own dog food and believe in tokenization of private markets, which is one of the trends that we have noticed, then we will be able to obtain liquidity faster than what our typical lockup period looks like, which is 8 years plus 2 extensions of 1 year. So there is a possibility. We don't want to promise this to our LPs, but it's one of the advantages, potential advantages of investing in blockchain.
Wow, I love that answer. I think it speaks volume why blockchain is an asset class which is rising, and also why many other people should be looking at it and maybe putting their money into it. So coming back to diversity, I would love to talk about a little bit about this, since you're on GVC. What is the diversity in your fund and in your startup's cap table that you're investing?
Right. I wish I had a better answer for you, but diversity is not good enough. And it's not good, and for probably a number of reasons, but one of those reasons is we are on the intersection of technology and finance. And that intersection, unfortunately, does not have a lot of women interested in it. So we have lack of diversity in terms of our portfolio companies. To give you an example, we looked at 700 companies in the last 12 months. I would say less than 5% of them had even a female co-founder, let alone a female founder. So if you think of our funnel, 700, less than 3 or 3 or 4 would be females that are now making a cut to 150 screen companies, 15 in vetting companies, and only 5 investments. So the funnel is not looking great. That's one. The second challenge is, even on our team, I'm the only female, with one exception of one advisor who is another, and that's not for the lack of trying, it's just lack of available talent, I guess, that we're exposed to. And then the third interesting finding that I have is I have close to 40 LPs in the fund now, and I don't have a single female LP in the fund. So there's a lack of diversity, unfortunately, on all fronts. And hopefully, fingers crossed, the best news for us will be the new company that I'm referring to. We're going to make an investment in the next couple of months. Their board is 60% female. And if I would be joining that board, it would be probably 70-80%, which would be, but I'll keep you posted on that. I don't know, do you have an opinion as to why this might be the case?
But I feel there should be women, especially at the LP side, institutional LP side, who should take this as an opportunity for them to come ahead and invest. I definitely think there would be more after this interview. And I want more fund managers to come and take a look at this, that this is an asset class that they can invest. There is a good opportunity for a look into it in a long-term basis.
Right.
So yeah, that is something.
So my guess is that similar funnel challenge that we're experiencing in terms of startups who have female as the leader, as the founder, we have the same challenge on the LP side, where a majority of LPs are male. So there are only a few female LPs out there chasing a few other female funds. So we just haven't made through the funnel yet. But I think if we want to fix the problem, we have to fix the funnel issue in the first place. And that's a conversation for another day, probably.
Yeah, and I want to highlight one of the things here is that most of the time people think that women fund managers or even the blockchain funds, they consider them more as a focus fund. And I want to tell you, like, even sports TMT is also considered like a focus fund. It's not generalist fund enough, but they don't understand that these kind of technologies are part of our society. These kind of technologies are very ingrained part of supply chain technology or other different asset classes, which can be looked at enterprise way, can be looked at the consumer side. And I think many LPs fail to understand, fail to overlook. This is an area of a great return. And I think they need to understand that a disciplined approach towards an investment thesis can actually bring great returns. So I hope that after this podcast, people can take that into account.
But overall, I'm not complaining. I think we're in a great place. And I do think that over the next 2 to 3 years, we're going to show those consistent year-over-year returns in terms of our portfolio companies, where now majority of companies are probably in the seed and A, post A, sometimes B stage of funding. In the next couple of years, we'll have more B plus, C, D, and some IPOs, and that will prove to investors who are still on the fence that this is the right asset class to get into. But obviously, they will forego the upside if they don't invest sooner.
Yeah, and I think things may change if they immediately find Bitcoin is going to the moon, because don't forget, we investors always have a herd mentality, so there are very few who continue to follow their disciplined thought process like you, even after the market has moved from the consumer to the much more in the enterprise sector. Not everybody is talking about Bitcoin. There was a time when even our grandparents are also talking about Bitcoin and why people have not invested when it was low. So I'm super excited to have you on SheVC, and I cannot believe now we are coming to very last question, which is venture capital is not a career. It's almost a lifestyle, especially for fund managers. They're also like entrepreneurs. They have to spend so much of time, energy raising money, so much of time and energy with their existing portfolios, helping them, being on board. There's so much things to do. And also with your personal life, so many things are happening. I would love to know how you're managing your work-life balance, especially when you're living where you're working nowadays. That's everybody's seen, and you're traveling also. So how you're managing, and also your upcoming new puzzles.
Well, it's like doing 3 jobs at the same time. And it's a similar challenge than every startup founder who's bootstrapped his or her startup all the way through different funding stages would experience. In our case, fundamentally, as a venture fund, you worry about 3 things. And each one of those 3 things is a full-time job. But one of those things is deal making. You have to be driving pipeline. You have to be converting deals. You have to be making great investments. That's a full-time job. The second one is portfolio growth and portfolio support. Once you made investments, your job is to make sure that those investments are accelerating and you're helping them get to the next stage. That's a full-time job, if not 2. And then the third one, which you're especially focusing on in the early stages of fund management, is fundraising and investor relations. Fundraising in the early stages, more investor relations in the later stages of the fund. And as you know, fundraising is probably 2 or 3 full-time jobs doing it properly. So you're juggling between those 3 different areas. So the way that we've sold for that, and not that we've sold it perfectly. We're still working on that. But we are compartmentalizing our time and we're compartmentalizing our resources. So we have resources such as advisors, mentors, interns dedicated to each one of those three areas. We dedicate venture partners to some of our portfolio companies to support with that portfolio growth. And we also compartmentalize time. So let's say if Monday and Wednesday is our deal days, then Tuesday and Thursday are our investor relations and fundraising days. And once fundraising is closed, which for us will be next month, we'll be focusing 100% on portfolio support and deploying the rest of the capital. So trying to do our best, but I've been in the high performance environment for the last 10 years. So it's not new to me. It's just a little bit of an adjustment.
Yeah, totally understand. So thanks a lot, Kate, for your time. And I'm super excited that you are here and you took some time out. I know you're closing your fund. You're also going to get married soon. So many things are happening. So I'm super excited, lucky, and congratulations on your upcoming nuptials. So, and I would like to wish you all the best and looking forward to hearing some great news from some of your portfolio companies.
Absolutely. Yeah, appreciate you having me here. And thank you for having all of those great female fund managers on your podcasts.